Happy Monday, everybody. I hope you had a good weekend. Sorry to say that we actually have a 5-day week again this week. So let's review what happened last week and let's preview the coming week ahead of us. Today is February 26, 2024, and this is your Monday market update. Last Monday, markets were closed for the President's Day holiday. I did get a kick out of some of my expats, my overseas clients who asked, what holiday was it? Many of them do have bigger things on their minds, though, so we understand. Tuesday had stocks come for sale on the open, led by tech. More on that in a moment. After a pretty quiet, long weekend, we did get a Chinese surprise rate cut, but it did not do enough to rally the markets. Markets did react to some earnings from Walmart and Home Depot in different directions. Seems that Walmart had good earnings and good forward guidance. Home Depot, good earnings, some weakness in same-store sales, and not so good forward guidance. Walmart also increased their dividend by 9% and announced that the already reported purchase of the TV maker Vizio. Now, just in case you wondered why, Vizio has an ad-supported model and Walmart wants more ad space. Markets like that. So back to the selling on the open. NVIDIA, the seemingly energizer bunny of stocks, did come down almost 4.5% on the day, and that was just to be in position ahead of their earnings later in the week. Stocks did rebound a bit in the afternoon. NVIDIA cut its losses in half. The markets closed slightly lower. The Dow was down less than 0.25%, the S&P down just under 2/3%, and the Nasdaq was just under 1% lower. On Wednesday, markets gapped lower. Again, weakness in tech, led by some more NVIDIA positioning, but also some hawkish Fed speak. A soft Treasury auction, and even thrown in there was another poor showing for Palo Alto Networks in the cybersecurity business. For the day, this was one of those. Tech had a hard day, but it was not so much more than money trying to find a way to broaden the markets. Only tech and communication services were down on the day. All other S&P sectors were in the green. Overall, a pretty quiet day, unless you own Palo Alto, and markets showed it. Even the Fed minutes that came out did little to excite markets. The Dow and the S&P were both up less than 0.25%. The Nasdaq was down less than 0.25%. Good thing that this was a quiet day. Here came NVIDIA day. After the close, NVIDIA came out with their earnings, and no matter how high the expectations were, and they were set that high, they were high. It seems that they surpassed them. So stocks ripped higher on the open, as I've been saying, taking the place previously held by Apple. NVIDIA was the make or break for the markets, and they came through. Overall, this was a catalyst for the move. Anything growth, and certainly anything AI related, it got buyers. By now, I imagine you've heard or read enough about the NVIDIA move, so if you still need more, please call me. Eco data came in favorable as well. Flash reports and home sales all came in line, and markets ate it all up. By the end of the day, the Dow was up almost 1.25%, the S&P up a bit over 2%. It is notable, it is the first time in 281 sessions that the S&P was up over 2% in one day. And the Nasdaq was up just under 3%. I'll have more in the wrap up in a moment. For now, let's close out the week. Friday, markets opened higher. Not major moves, but after Thursday, still moving up. Momentum, if nothing else. NVIDIA and friends led things higher, but closed well off the highs for the day. Just some more fun facts. Then some more of my thoughts on these facts. You may recall that in the past few years of these videos, I've spoken about target price increases and decreases. Well, wow. Research may have to start printing in pencil. They can't seem to increase the target price fast enough. NVIDIA for one, but even for the S&P 500. More on that soon. Market ended with a bit of a fizzle for the day. The Dow up less than 0.25%, S&P up just 3 basis points, and Nasdaq was up just over 0.25%. For the week, the Dow was up 1.33%, S&P up 1.23%, the Nasdaq was up just under 1.5%. For the week, the big winners, food. Yes, Kraft, Hormel, Conagra, all up over 4%. Consumer staples up 2.2% for the week. Tech up 2.1%, right behind that. So as this was another week for the record books, among so many other records, Japan finally set a new high, first time since 1989 as a market. I want to address the bubble question. One of my research partners had an interesting way of evaluation, and I wanted to share that with you. This is just another opinion, and this is not of LPL research. This is from Tom Essay, and here is his thought. Just an interesting way to think about things. Let's give it just after the Super Bowl comparisons. He says, how are the Mag 7 like the Chiefs? Now, I won't go too deep into it, but you'll understand. On the simple level about earnings, you know that I always come back to this. Earnings drive markets over the long term. 2024 S&P earnings are currently expected to be $243 a share. The Mag 7 are expected to earn 74 of those $243. That's about 30%. Yes, quick math, 1.5% of the companies, 7 stocks are expected to account for 30% of earnings. Here comes the comparison. If they do not deliver, we can expect major changes to the S&P 2024 earnings estimates as a whole, and that's all about valuations. Like the Chiefs, and you know I'm not a sports guy, but this only works now with the Chiefs because of the Super Bowl. But if there's 2 star players, or even one of them, God forbid, gets hurt, the Chiefs more likely than not do not make or win the Super Bowl. This can be for any team with a star or a few stars. Overall, as the week played out so far, the star players are in great shape, or it seems that way, but we'll have to see. And note that when we talk about this and we discuss this as a risk conversation last week on Friday's video, the risk is up there. This is just something to keep in mind. Add a few more important facts. All of the oxygen seems to be taken from the room by NVIDIA, but there has been some news on the other side in the past few weeks. First, inflation metrics are rebounding the wrong way. Also, the Fed has virtually told you that they are not cutting rates until late 2024 at the earliest, which is major news compared to the January expectations. Add in retail sales and the possible read that gives on the consumer. And finally, the polls, not the presidential polls, but the CNN fear greed indicator is at 78 out of 100, well into extreme greed territory. The AAII Investor Sentiment Survey shows 44% bulls, again, extreme territory. Investor Intelligence Advisor Sentiment Survey also, bull-bear spread at 41.1%, highest since July 2021. I'm not suggesting that this is the final curtain call for this market. What I'm saying is that risk must be reviewed at these levels. Can your plan handle a stumble, even a short-term stumble? This is what you need to review. Please be in touch to do so. Like many of you, we've been through this many times, and I don't want to come across a market dip without talking about what may cause it. There will be plenty of people to list that after the fact, what did cause it. But let's talk about this now so we can know what to expect as best we can. Let's talk about this week. This week's going to be full of more earnings, all second fiddle to the NVIDIA news, but they still may move markets. Watch for the AI connection, Salesforce, Dell, Best Buy, Snowflake, and what has become normal, just listen to every company mention it. They have to try to get their piece of the pie, AI. We'll also get GDP numbers and some other second-tier eco data. That's only second tier because markets seem not to care. Jobs numbers on Thursday to try to make a splash. Finally, Thursday will also be the PCE. That's the personal consumption expenditures. And if you needed someone aside from me to verify that this is what the Fed watched, Kashkari last week, the Fed head, he said so. Over the week, we'll also get Fed heads: Schmid, Barr, Bostic, Collins, Williams, Goolsbee, Mester, Logan, Waller, Daly, and Kugler. Before I close the day, expect to hear a lot today and this week about Berkshire and Warren Buffett from his earnings report and, of course, his letter to shareholders that came out on Saturday. Who else can get away with reporting on Saturday and having it covered by everyone? There will be a lot to learn from this. This is time to take a deep breath. I can't help but feel like we are on a treadmill, and as much as we try to control the speed, someone keeps turning it faster, and we have to run or get off. This is the time we must dig in and plan. Please, this is one of those times. We love market highs, especially records. Let's just make sure we pay attention. If you missed Friday's videos, I spoke about asset location, asset allocation, and portfolio weighting. Please check it out. For now, stay in touch. It may be the right thing for you to do is to get off that treadmill for a bit. That can mean anything you want it to. I might suggest is just start a good book and turn off the news, but I'm happy to discuss what is happening in your plan and what the proper actions may be. Please call. Have a great week.